What's up, skinny lips? Nice. Welcome. How you doing? Dog is downstairs, so I can call him up actually. I'll call him up in a little bit. He got a bath today. What's up, in code? It's one too many Ks there. Jesus. I will not. Weather's fucking cold today. Jesus, it's like -6. Yeah, I've literally been shoveling snow for like months now. It never stops. Alright, let's get into it. Alright, welcome everybody to Tuesday. I hope you guys are having a wonderful start to your day, making lots and lots of trades. Before we start off, a couple of disclaimers. I'm not a financial advisor. This is not financial advice. I'm just a trader trading my own shit. For all of the tools I'll be using on the stream, they can be found on the bapegindicator.com website. These guys make the best mathematics-based indicators on TradingView. They also have a lot of free tools available, so do check them out. Do yourself a favor, get away from TA, get away from all those triangles and RSIs. There's a referral link in the description of the stream. Also, I'm not sure, actually, I think our Discord got changed over, or it may be closed right now. The link to the Discord that's in the description is currently, I think, to our main Discord. I'm not sure if you'll be able to get in there or not. But do try it out. Also, I do have a Twitter available, so do follow me there as well. I do my best to post occurrences outside of the stream. All right, sorry. We had a pretty nutty discussion on rates, inflation, China, and money today, and I think it's still going on over in Discord. I'm just reading over that. All right, I'll leave that for a little bit later. Let's start off with the markets as we usually do. Welcome, everybody. All right, let's start with the world indices. How did the world do yesterday? Australia took a nice little step up. Entropy still moving down on the do currently. So this could potentially serve as a level from which the price will... I hate using the term reject, but... the do has been pretty damn good at getting some occurrences, especially when the market is in some sort of trend, when volatility is rising. Let me actually double check that. I don't want to be saying stuff if it is not true. Maybe let's go to a higher time frame. Is this actually a falling volatility environment here? Just some sort of drift. Do we have autocorrelation present? Yes, we do on the Hearst there. Let's see what we are doing currently. We are on the do on the second expected move. Entropy still moving down. Still favorable environment for the Delta traders, but the QCV occurrence has stopped. HVP at 73, and also SSR moving up above the upper band there. Not much in terms of extremes. Yeah, still in some sort of a random walk here. As long as we are below the do, I would expect the big changes in price to still come to the downside. Let's take a look at the weekly. On the first expected move for the week, so you have a 70% chance of closing this week below 7,191. He is Canadian, so probably Celsius. Yes. Yes, definitely Celsius. I don't know why America uses Fahrenheit. It's a... Oh, I'm not gonna shit on it. Alright. I don't get it. I don't use it. We use Celsius. Germany, entropy still moving down. This, as long as this persists, still likely to be a more favorable environment for Delta traders. It is on the 95 filter. It is looking for significant changes in price. QCV still turned up, HVP at 32, so likely some volatility incoming and autocorrelation present as well on DWT and the Hearst and the SSR as well. As long as that persists, likely more downside for Germany 30. Fahrenheit is based on body temp scale. Wow, powerful. Shrug science is what it is. Oh man. Yeah, new SSR is fucking fire. I love the addition of the mid band. I'm not really sure what you did to the math behind it, but it seems to get the moves way better. And it's not giving you as many occurrences outside of the band as well, so that's pretty fucking great. Fahrenheit is dumb. Right there, you heard it here first, boys. Let's take a look at Russia. So for the Russian market, we were looking at a pretty extreme HVP reading. This was at 100 at 99.45, currently still above the moving average, so this can persist for an indefinite period of time. Hearst is still in trend, VRT possible positive autocorrelation, but the extreme here is definitely in volatility. Likely that cools off over some amount of days. I would like to see it start actually moving below the MA in order to call that, but on the weekly you still do have room, so maybe cool off for, you know, next couple of weeks before going for another run. We'll have to wait and see for that to occur. Also on the weekly, the SSR is above the mid band, suggesting a big massive move. That's fucking crazy. That's fucking crazy. Entropy still moving down on the weekly as well. Market is not in a random walk. On the daily, anything extreme to bet on? No, I think the volatility is likely the thing to bet on here. Being very extreme. Global Giant, welcome. Speaking of big massive moves, Facebook is wrecked, is it? We'll take a look at the the Zuck coin. All right, let's get through these. How much more? Oh shit, we don't have much time at all. Moscow, HVP at 98. That's very similar extreme, still above the MA. Would wait for that in order to call probably a decline in volatility over the next 30, 60, 120 days. Looks like entropy has started to move up as well, but nothing too crazy here. It's still depressed from this big massive move down. Let's take a look at UK. Oh, the one thing on MOEX, likely spike in volatility over the next couple of weeks or so, as the HVZ is on the lower band as well. These give you pretty damn quick bouts. Let's see how long this one lasted. This one was a week, 8 bars. Let's take a look at UK. UK was looking pretty good with entropy moving lower. We were suggesting, hey, there's nothing too significant yet. It's still at a pretty high level. Looks like it didn't persist. Now it looks like it's attempting to go again. Volatility is low enough at 22. That's the one thing that I would like to bet on, is probably higher volatility for the UK market. Very low on the weekly. At 6, QCV turned up, and Hearst is entering trend here on the weekly as well. So likely higher volatility here. I thought body temp would be exactly like 100, not even. Yeah, Fahrenheit is weird. Fahrenheit is extremely odd way to take the temperature. But then if you think about it, so are inches and miles. I feel like centimeters and meters and kilometers make a lot more sense. At least, I don't know, maybe that's that's from school. China took a pretty damn big step down below the first expected move, almost got to the second expected move. Still expecting higher volatility for China in the future. It looks like it's rising, currently at 21. Hang Seng, not much has changed. Price still above the due. HVP at 64. HVZ near the upper band. Nothing too out of the ordinary here. Nothing too extreme to sort of make bets on or call. As long as this the price remains above the due, I would expect the big changes in price to come to the upside. Let's take a look at Japan. Yeah, Japan taking, well, not really any change. Entropy still moving down. Favorable environment for Delta traders with big changes in price expected to the downside. Plenty of room on volatility. HVP at 38. All right, Nikkei. Probably a spike of volatility incoming. HVZ near the lower band. Other than that, nothing too extreme here. No change since yesterday. All right, Dow Jones. Market is still inefficient. VRT suggesting this is not in a random walk. Sorry, let me just change the song quickly. There we go. Suggesting market is not in a random walk. Plenty of room for volatility to take place. Likely, this inefficiency will get traded away over maybe even this week. If not, then the start of next week. Unlikely to persist for a very long period of time. Possible positive autocorrelation here. And let's take a look at MOM. Entropy still pretty high, not a favorable environment for Delta traders. Room for volatility to take place though. HVZ near the lower band as well. What the fuck is going on in chat? Studied nanoscale friction. All right. Let's see how the S&P 500 open. We have... Oh, no, it's open already. All right, sorry, boys. I'm a little bit asleep today. Also, VRT not in a random walk here. Entropy moving down. The price is below the due, suggesting favorable environment for Delta traders, and the big changes in price expected to the downside. Is MOM negative here? ACDC is negative. HVP at 68. Does have room, and HVZ near the lower band, so likely volatility incoming. Also, SSR is above the upper band, although the MA on it has gone red. Let's take a look at Nasdaq. Yeah, Nasdaq opened down today, approaching the first expected move. 70% chance we close above 14,456. HVZ near the bottom band. SSR above the mid band, and entropy still moving down. Not a good look for Nasdaq. The scary thing about Nasdaq that we've been looking at is the weekly being below the due, with entropy moving down. Do I not have it? Oh, why do I have a different index? NQ1. Yeah, with entropy moving down, suggesting a favorable environment for Delta traders, and QCV turning up, and HVP at 63, so you do have room for volatility to take place, although the SSR is not above the mid band quite yet. So hopefully that will be the rescue. I sure would like to just get long on shit and forget it. All right, what's going on in chat here? Is this dude bothering you here? Just, don't you have mod? There we go. There you go. Done deal. Done deal. All right, let's take a look at the VIX. Actually, let's take a look at the daily. Anything crazy on the daily? No, not much. Probably a volatility spike incoming, though. HVZ pretty damn low, and SSR is above the mid-band, so do be aware of that. Volatility, the VIX also not in a random walk. HVP at 50, plenty of room to move up. With HVZ, looks like it's coming off the bottom band here, and entropy moving down as well. Currently, the big changes in price are expected to the downside, although VRT being where it is suggesting the market is inefficient, and this could get traded away. I don't know if it's what would you say? I don't know if it's reasonable to make directional calls off of VRT, like in which direction it will get traded away. I don't think that can be done. Maybe somebody can enlighten me about that. But currently, the market is inefficient. Returns, the mean forward returns is also positive here. So if we do see a VIX spike followed by like a S&P dump here from the dude, that would kind of make sense. And probably that does take care of the VRT being at a significant level. All right, let's take a look at the cryptos. How are we doing? Bitcoin hitting the first expected move to the upside. Nice. 70% chance that you close today below 45,367. Looks like it got right on it and took a little bit of a dip. To the downside, 70% chance we close above 42,275 today. Speedstrone, what's going on? How you doing? Anything crazy? No, we saw mean reversion on Hearst for 1 day. Yesterday, we saw it yesterday being mean reversion for the Hearst. Currently back in trend. We do have to wait for this day to settle, but looks like QCV is going for a cross up again. Again, plenty of room on volatility. This is the big bet that I'm sticking with. Likely higher volatility over the next 30, 60, 120 days. So far, looks like the significant changes in price are going to come to the upside. However, this is not favorable for Delta traders as entropy is pretty damn high. Possible positive autocorrelation here on the VRT as well as the Hearst. Let's take a look at the weekly. How are we doing there? So the weekly has a problem with the due price is still below it. We'll have to wait and see where it closes. 70% chance we close the week below 47,474. All right, let's take a look at Ethereum. Ethereum taking a bit of a bigger step down, still within the first expected move though. For today, 70% chance we close above 2,996. I like that Vlad called you Speedstrone, like testosterone, and not Speedster One. People always put their names together, and I always read it the wrong way. Is it? I guess Speedster One makes more sense. I like Speedstrom better though. Hey man, you want good words, get a languager. All right, HEP at 32, likely see a spike in volatility, and SSR is on the mid band here. So if a big move were to come, that would be pretty consistent with where the SSR is. Has plenty of room to make a move up, and yeah, I'm gonna leave it at that. Has plenty of room to make a move up. The mean forward returns has gone negative. Certainly not a good sign as long as that persists. And mom gave you a cross down, and looks like this positivity is going away. Hopefully it does remain above the due. For full disclosure, I still have my puts, which I didn't sell. I had a straddle on from February the 2nd on this down day. I put a straddle on. I sold the calls in profit. That was fucking fantastic. And I just left the puts. They got some premium on them. Let me see. But not much. So I'm going to leave them be. They're pretty far out there. June 24th. Let me actually see how far that is. 135 days. All right, what did Encode say that is banned? You know, you need to get your Speedstrone checked when foreplay lasts less than a minute. Speedstrone replacement therapy, that's right. All right, do we want to check rates? Yes, let's check rates. Rates are moving up. Pretty crazy shit. Especially if this does continue. The cross on QCV hasn't happened yet, but looks to be coming. The problem here is that the 30s divided by the 5s, which is what CNBC usually freaks out about when these invert, which is what all the boomers freak out about when they invert. This sign of recession to them. This rate has been going lower over time, so the difference between the 30 years and the 5 years has been getting less and less significant. When this does approach zero, that's not going to be a very good look for the market overall, suggesting that there is some sort of problem, because it'll cost you less money to borrow 30 years out than it would 5 years out. Certainly doesn't make much economic sense, as you're taking much more risk by lending 30 years out. All right, let's take a look. This $, yeah, nothing too significant. Let's take a look at some currencies. We actually haven't looked at currencies in a while. I think the most significant thing is really Dixie. Pretty high volatility on the daily, but if you do go out on the weekly, you have a lot of room for volatility to take place. So this is likely into 2022, 2023. I think Dixie is going to have a pretty big, massive move. Currently, HVP is at 15, coming off of a 0 flash. So it looks like it started to pick up already. But you do have plenty of room for volatility in Dixie to take place. Keep in mind that most of this basket is just euro. Is that similar with some other ones? No, maybe the ruble. Maybe the ruble with HVP at 25 seems to be picking up over time as well. Our TLTs doing? TLTs are getting killed. Holy shit. And how's gold doing? So gold is the other one where we've been looking for volatility as well for quite a while. HEP at 12, so pretty damn low. SSR above the mid band, suggesting big massive moves if the MA goes blue here. Currently the big changes in price are expected to the upside. This will certainly make Peter Schiff pretty damn happy. Entropy moving down, but nothing too significant here, and not much in the way of autocorrelation. So we could continue doing this thing where volatility picks up, gives you a spike, and essentially price stays pretty much the same over a long period of time. So if we do see autocorrelation come into the market, that will be much better for a trending play or a directional play, because then the assumption will be that, hey, positive returns are likely to be followed by positive returns and vice versa. But volatility bet is pretty damn decent one. Let's take a look at the weekly on this. It does seem to be still cooling on the weekly at 27.4. Let me know if there's anything you guys want to take a look at in the chat. I would be more than happy to take a look at it. Otherwise, we will just go into getting set up for the day, taking a look at some of the crypto stuff, and hopefully finding some opportunity. And what else did I do? I did Delta as well. So I went on to Delta. I did sign up for an account with them because they do have more options available, but it looks like still a pretty damn limited amount of assets there. Between these Bitcoin, Ethereum, BNB, XRP, Solana, Link, AVAX, and Matic. Certainly better than what I have now with just Ethereum and Bitcoin, but still rather limited. XRP USD, yeah, let's take a look. Maybe we can get more. Oh, this is weekly, excuse me. Let's take a look at the daily. So XRP for today went above its first expected move. 70% chance you close today below 0.87509. Looks like a decent spike in volatility. HVZ already at extreme outside of the band there, so probably cools over the next couple of days. Have to wait and see for that. The market is not in a random walk according to VRT, and there is trend present. Let's see how you did on the probabilities as well. Let's go 5 bars back. Yeah, somewhere between the 5% cone and the 1% cone. Sorry, I have this on 0.4. Could you look at Ford and ARUSD? Yes, absolutely. Yeah, somewhere between the 5% cone and the 1% cone. So if you're betting on immediate upside here on the daily, you are betting on getting 4.32 heads in a row or 6.64 heads in a row, somewhere between those two. So can that happen? Yes, coins do go for runs, but it's just not a worthwhile bet. There are probably better bets. Alapor, welcome. BTC, please. Yes, we have just taken a look at BTC, but we'll go over it once again and maybe go into the shorter term stuff. Let's take a look, see at volatility on the daily. For volatility, still have plenty of room. HVP at 29, but probably in the short term does cool off just a little bit as you just had a spike in the HVZ. Overall looks good. Overall looks good, especially as the QCV is turned up as well. Let's take a look at the shorter term stuff, maybe a 1 hour. Yeah, 1 hour HVP got pretty extreme. I think that's all the way at 100. I don't have that metric, but currently at 98.36, certainly is pretty damn extreme. So unlikely to go much further from here. Maybe let me put it a different way. You don't have much room for volatility to continue expanding. It can persist for an undefined period of time being at this level, but my assumption here would be that it cools before you get another spike in volatility. And essentially, if you are trying to catch some sort of a trending move, what you're looking for is a volatility expansion and some sort of autocorrelation on Hearst, best of all, maybe on entropy, maybe on the QCV. Maybe on VRT or DWT or the SSR. A lot of those do incorporate some sort of, well, maybe not the QCV, but nevertheless, you are betting on volatility expansions and autocorrelation being present. And currently, you don't have room for volatility to take place based on an hourly time frame. All right, let's take a look at Ford, ARUSD, and then we will go into Bitcoin once more. All right, holy shit. Ford missed earnings completely, hey? Pretty extreme on volatility at 99.45. This can persist for an undefined period of time. QCV also turned up for a big, massive move here. As long as that persists, let's let the mom load in. I'm assuming that's negative. And Hearst is in trend. VRT suggesting possible positive autocorrelation. Market is not following a random walk. Let's see what kind of probabilities you're getting here. 16 bars back. Did something happen with Ford, or did is this just based on earnings and nothing else really came out? Yeah, Ford on 0.01% probability. If you want to continue betting short, or if you are betting short here, you're at a pretty extreme probability here. Breaking this right here, right now, would be like getting 13.29 hits in a row. Certainly possible, but very, very, very unlikely. They cut outputs or something. Okay. I'm assuming the IV rank on this is pretty damn high too. Chip shortage, they cut outputs. Okay, that makes sense. Probably the IV rank on this is pretty damn high. I'm assuming you could make some great options plays, shorting puts and maybe even covering those with a put further out. You'd have to do some, well, not some out, but you'd have to look at theta versus delta, but I'm sure there are plays to be structured here. If you wanted to, or personally, if this was up to me, I would attempt to short some puts naked, probably, because HVV is pretty damn high. Maybe a better call would be to wait for volatility to start cooling off altogether before doing that, but I think that's the play to make here. Damn, crazy move for Ford. Looks right for put spreads indeed. Yes, some sort of short volatility play. From probability perspective, that's crazy. 0.01, we don't see that often at all. Damn. Nice find. AR USD, let's take a look at that. All right, I'm assuming crypto. Is this a recent one? Yeah, this is a more recent one. We don't have much data on something like this, but let's take a look at the data we do have. Price above the due, the significant changes in price are expected to the upside as long as that persists. Maybe let's take a look at the shorter term stuff. Nice, a nice rise in volatility here, currently at 78, so still do have some room for that. The big changes in price are expected to the downside on the hourly. Looks like if you're not participating in this already, it looks like you may have missed it. From an entropy perspective, getting less favorable for delta players. As long as below the due, though, you do still have a bit of room on the HVP here. And likely more downside as long as that does persist. And let's take a look at BTC. How did we start the day? Let's start off with the shorter term stuff. And let me just reset the cone here. Man, still hanging on to the due. HVP at 45, so does have some room. Nothing too extreme here to make bets on. Generally speaking, probably more upside as long as it remains above the due. I don't have a very big opinion on whether it does that or not. Hearst is in trend at 0.528. Looks like this has just started trending. Come on, mom, load in. Anything crazy on the probabilities? Let's maybe set this like over here, 40 bars back. Yeah, you got to somewhere between 5 and the 1% cone, so it's just getting less and less likely that you are going to see further upside above there. Yeah, nothing too extreme on the shorter term stuff on the 1 hour. Let's take a look at the 4 hour. Okay, the 4 hour is a little bit crazier. Let's take a look at 29 bars back. Volatility rising, currently at 65, so do have some room there. Hearst is in trend, attempting to go into significant trend here, but where you are on the probabilities is pretty damn crazy. Above the 1% cone, let's take a look at like a 0.1. Maybe a 0.2. Yeah, if you are betting long here, you're betting on getting 9 heads in a row. Very, very unlikely. Also, entropy looks like it has started to move back up as well. I wouldn't be taking positions right here, right now, based on this 4 hour. Probably do have some more room for volatility to continue expanding here. Let's take a look at the daily. For the daily, you are still within the first expected move. You have 70% chance of closing between 45,367 and 42,274 for today. The big thing for Bitcoin is still HVP at 8.77. Over the next 30, 60, 120 days, we're going to see some crazy shit, I think. The bet to make here, I don't think it's going to be directional. I mean, you don't have entropy on your side. I guess you could use the due to manage and mom as well. But I think that the more sound thing to do, at least for myself, would be to take a bet on volatility over that period of time, remaining direction neutral. I'll make less money, but I'll have more probability of success in that trade, and I think that's probably more important for longevity. It's pretty extreme in HVP. How can you bet on volatility by straddling? You can buy premium You can buy calls and puts together at the same strike at the same expiry date. That's one way of betting long on volatility. There are there are a lot of other ways as well. I would suggest a resource for you if you are new and trying to learn. Let me get on this here. Let me not dox myself here. So there's a great website called tastytrade.com. It's a fantastic resource, completely free, not affiliated with us. They have an on-demand playlist, tastytrade.com. Oh, what? Server error. Oh no. What happened? Is there shit down? Okay, here we go. On-demand section. They have a lot of playlists, but the one that I would recommend to you is the Skinny on Options Math, and I think there's another one where they do the actual options plays and ways of betting on, yeah, for example, options crash course. Not everything they say is going to be necessarily 100% correct, but as far as starting out goes, a fantastic resource and completely free. Most importantly, I don't know what's going on with their website today, but usually there are shows available. Check them out. You might have to wait for a little while, but you might have to wait for a little while for the videos to come back, but I think they should at some point. I don't know what it is with them today. They're getting hacked. They're getting hacked. It's the Russians. Quick, let's invade. Sell a call and a put at the money with like 45 days out. So that's a way of going short on volatility. All right. I hope that answered it. Let's take a look at some more crypto stuff for today. Maybe on the shorter term time frame. Is there anything to bet on here? Just stay away from Grayson Jones. Yeah, there are a bunch of playlists on there that like you don't really want to touch with a 10-foot pole, but overall, in the grand scheme of things, for being a free resource, considering that all the TA re's charge you like $2,000 for courses that are way worse than that, it's pretty damn informative. It's pretty damn informative. Oh, they do have YouTube content as well. Nice. Okay. Matic. Don't have much data on this stuff. Has Matic been around for a while? What is Matic? Does anybody know? Does anybody actually participate in this shit? Yeah, nothing too crazy. I'd like to structure some sort of options plays on some of these, as I do have access to Delta now. I think I will let my options position on Ethereum just run and end up transferring some stuff over to Delta to start doing actual options plays. I would like to bet on some sort of extreme though. Has something to do with gaming, I think. Okay. Maybe even on the shorter term time frames. I was looking over like a documentary on Jim Simmons. Actually, this might be a good play for long fall for Link. Currently at 13 with the HVZ being pretty low. I was looking at the fund that Jim Simmons was running, and I think his average hold time was like a day and a half, which is pretty fucking crazy. Because I do all my trades like 120 days out and I just sit on them. But if this guy's doing occurrences every day and a half, that's pretty decent. Oh, nice. XRP probably short volatility. How's it on like a 4 hour? 4 hours still has room. Yeah, the short term stuff doesn't look too hot. For Bitcoin, for the majors at least, Bitcoin and Ethereum, SSR still above the mid band. If it turns up here, that's not going to be a good look. With price being below the due and HVP at 17, plenty of room there to continue expanding. Plenty of room. Tesla 1 hour has low volatility. Another opportunity for options play. Let's take a look. Oh yeah, it does at 5.75. Holy shit. What's this like on a 4 hour? 4 hours pretty damn high though. So if it is a play, it's well, it's probably not bad for like a day or so. That's probably not bad. Let's take a look at the daily as well. Daily at 63 now. Man, I'm so choked I missed this fucking vol play. We were looking at this for so damn long. We were looking at it for so long. Where's some probability to? 24 bars. Yeah, somewhere between the 1 and the 5% cone. No worries, some volatile dude. How you doing? Yes, yeah, speed strong. Good good find. Good find on Tesla. This is probably a decent play for options over the next day and a half. I think on the 4 hour it's pretty tapped out at 92. Some room to continue going, but on the hourly, pretty damn low. Pretty damn low. Yeah, all is well. Just trying to. Oh, you know what? Weebos posted a list as well. We should have checked that as well. Let's take a look. XPR. Yeah, pretty good. I don't know how he fucking finds these ones. HVP at 18, plenty of room to continue expanding. Unlikely to persist though, with the new SSR being outside of the band. Maybe wait a couple of days if you want to be directionally long, or if you want to add this to your portfolio. I don't think this is very likely to continue in this fashion. What else does he have on there? High rank tools, options volume, OI, low IV rank, BAC, fun. BP. Alright, perfect. Let's take a look. Damn, are banks about to go for a run now too? Is this daily? Yeah, this is daily. Actually, though, a decent long setup here, as long as price above the due, entropy moves down, and QCV is crossed up. I only bank at Quadriga CX. Powerful. Yeah. I used to bank with Quadriga CX. I exit scammed early though. It's okay. How's Hearst? Hearst is not in trend quite yet. But as long as mom's positive here, price is above the due and SSR is moving up. Pretty damn good for a long here. We got plenty of room. Well, not plenty. Your HEP is at 53, so you have some room. Everyone exit scam Quadriga. Yeah, so, some got scam exited though. Some didn't. Some didn't. What's the banking ETF? Let me find that. Let's see how overall the banks are doing. KB, that's what it was. Yeah, probably a spike of volatility in the banks, at least from the ETF. Market's not in a random walk. HVZ very low. Ruble devs doing slow rug on the bro. SSR moving up here above the mid band as well. Powerful, powerful stuff. Yeah, probably banks go for a run here. Ruble. What the fuck? Tron. Let's take a look. This is from yesterday? Yeah, there's that volatility. Sorry, bro. Sorry, my guy. Bro, the puts are printing today. Holy shit. TradingView shit as always. Why isn't the cone loading? Come on. Please. Oh my god. When learn inflation. Oh, by the way, should we watch the video on... Fuck, what was it on? Here. Yeah, okay, let's watch the video. Currency Exchange Introduction by Khan Academy. Where is it? The video sucks, goddamn. Alright, we'll leave Tron on. We got the cone up. No, let's leave Ethereum on. This is the one that I still have position on. All right, ready for learns? Let's learns.
how a market for currencies would actually work. And it's very non-intuitive for a lot of people because we're going to be talking about currencies becoming more expensive or cheaper, or the price of a currency in terms of another one. And what I want to do is give you a very intuitive feel for that. So let's say
Yeah, I don't see
we're
anything
well,
either.
just because this is it's a hot topic right now. Let's just
Oh,
make the two currencies the Chinese renminbi and the U.S. dollar.
there you go.
And the unit of
Welcome.
exchange, and China's a little confusing because
I'm a
sometimes they use the word
professional.
renminbi, sometimes the word yuan. The yuan is the unit of the renminbi. So let's say right now, if I were to just go on some website, and this is not the actual exchange rate right now, but let's say right now the quoted exchange rate is 10 won, 10 won per US dollar. 10 won is equal to 1 US dollar. And every time I say dollar in this video, I'm referring to the US dollar is equal to 1 US dollar. And I think this makes sense to a lot of people. If I have $1, I want to convert it to won. I get 10 of them. If I have 10 won, I want to convert it to dollars. Someone's going to give me a dollar for it. Now let's imagine a situation, and in the next few videos, I'll construct actual trade imbalances where this would actually happen. But let's say we live in a reality where there are 1,000. So let's say, someone has 1,000 won. So let's say that this person right here, has 1,000 won. Let me write over here. Has 1,000
Is that
won
okay for volume?
and wants to convert to dollars, and wants to convert to dollars. Now let's say on this side, and if we just superficially looked at this 1,000 won and looked at the quoted rate, we'd say, hey, that 1,000 won, you get 10 won per dollar, so that should be $100 at the quoted rate. But let's say you have two other actors over here. And obviously these markets involve many, many more than just three people, but this will help us simplify or at least understand how these exchange rates would work. Let's say that this person right here, with the mustache, let's say that this person right over there, and maybe a hat as well. Let's say that he has, let's say that he has, let's say that he has $50. Let's say he has $100, has $100, that he needs to convert to yuan. Maybe he wants to buy some Chinese goods. Maybe he's a Chinese factory owner who sold his goods in the US for $100, and now he needs to convert it back to yuan to pay his employees or pay his own mortgage or who knows what. And let's say that there's another person. Let's say that there's another character over here. There's another character over here. And let's say that she also, let's say that she also has, let's say that she also has, let's say that she has $100 that need to be converted into yuan. So net net, what's happening here? What's the total demand to convert yuan into dollars and dollars into yuan? Well, if you look at the whole market, you have $200 that need to be converted into yuan. So let me write this down. We have a situation where $200 need to be converted into yuan. And then to kind of off on the other side of that transaction, we have 1,000 won need to be converted into dollars. So now we have 1,000 won. 1,000 won need to be converted into dollars. And for simplicity, these are the only actors. They are representing the entire market. Although, as we know, the entire
Yeah, I mean, it
currency
is
markets,
basic, but
especially
I think that's the
there's
point.
thousands or even millions of actors actively participating in them. So what's going to happen? All of these people might just go on the internet and look up the current exchange rate, or the last exchange that occurred, and said, hey, you know what? Me over here, this $100, I should be able to convert it into 1,000 won. But she also says I should be able to convert this $100 into 1,000 won. So they collectively think that that $200 can be converted into 2,000 won. So I'll put this in question marks. So will they be able to convert this into 2,000 won? Into 2,000 won. And on this person over here, he's saying, well, just at the current exchange rate, maybe I'll be able to get for my 1,000 won, maybe I'll get $100. But everyone wants to maximize the amount of the other currency they get for obvious reasons. They want to maximize the amount of money they get. Now, will these two people be able to convert their money into 2,000 won? Remember, what I said is this is the entire market. And it's a huge simplification. But there is this imbalance here. More dollars into won than won into dollars. Now, they won't be able to convert into 2,000 won because there's only 1,000 won that wants to be traded. There is only 1,000 won that wants to be traded. So you can imagine this guy over here, maybe he wants to do it slowly just to kind of see what the market is like. So let's say let's say at first he puts 10 won up, essentially for bid. You could view it either way. You could say that maybe one of these people put $1 up for bid, and this guy is bidding on that dollar in terms of won. Or this guy is putting won up for bid, and these guys are going to bid on it in terms of dollars. Either one. And that's why it's sometimes confusing with currencies, because you're buying another currency. But since this guy is more in demand, since this guy is more in demand, more demand. To simplify things, I'll make him the person that's kind of able to create an auction type situation, which really what the markets are trying to do, so that you can equalize supply and demand. So he might initially say, hey, you know what? I want to convert. He has 100 won and he wants to convert it. So he says, you know what? I'm willing to sell 100 won for $10. So let's say he sells 100 won for $10. So he sells 100, or offers, I should say. Offers to sell 100 won for $10. He just thinks that that's a fair offer price right over there. And that's this guy over here. This guy actually converting won into dollars. Well, what's going to happen? Well, one of these people is just going to jump at that. They say, oh, you know what? I think that's a fair price. And so let's say this woman right over here takes it. Then actually both of them maybe saw that offer to sell 100 won for $10, and they both try to click their mouse, or however they're trying to make the transaction happening. But let's say she clicks her mouse a little faster and she gets the transaction. So let's say that person, let's call this person B, and this is person A, and this is person C. So person B accepts. Person B accepts. So two things happen just then. One is person C says, wow, that was pretty fast. Someone was very willing to take it for 10 won per US dollar. And then this guy goes like, my God, I need to convert my money into won, but I wasn't able to. Someone else beat me to the punch. So this guy over here is not an idiot. He's like, hey, maybe people are willing to give me more dollars per won. So let's say that this guy right over here, this guy in orange, he then offers to sell, let's say he wants to sell 90 won. 90
The
won
video I said we watched was
for
the sixth
$10.
one. The
Notice
fuck,
the
man.
price of the won has now gone
Yeah,
up,
we're
or the
not gonna
price of
watch
the
all that.
dollar has now
We'll
gone
start here.
down.
We'll start
Either
from the
one. Those are
basics.
the symmetric statements. They mean the exact same thing. So all of a sudden, this person has a lot of dollars he needs to convert into won. So he accepts really fast. So person A accepts. And I'm doing a huge oversimplification, but it gives you the general idea to show you that this really is a market. So person A accepts. All of a sudden, we have a new quoted exchange rate. All of a sudden, we have an exchange rate of, what is this? 9 wons. So we have new quoted rate, or the transaction happens at 9 wons, 9 wons per dollar.
Okay,
Now, what's
well,
happening?
I think we understand currency exchange. Okay, let's I think boys, we did it. All right, let's go. American Chinese debt loop. This, can we do speed? Let's go speed.
To make sure that the yuan does not appreciate too much. So the way they did that is that they bought up all of the excess dollars using yuan that they printed. So what they do is they print yuan. I'll do it in this blue color. So they print yuan, print yuan, and then they use that printed yuan to buy dollars in the open market. And what that does is it props up the demand for dollars and keeps the price of yuan down. So then they get dollars. So they print yuan and they buy dollars. They buy dollars. And as we saw, they have to keep doing this in order to keep the yuan, in order to keep it deflated, or in order to keep the dollar inflated. And this is so that they can maintain that they're a favorable balance of trade. But as they do this, they're just building the stockpile of dollar reserves. So they are just building this stockpile of dollar reserves. And as we mentioned in the last video, they're not just keeping a big vault of dollar bills there. They're going to use it to buy assets. And they're going to buy liquid and safe assets. And the main asset they're going to buy is U.S. Treasury bills. So then they take these dollars, and they buy U.S. Treasury bills. And let me draw some of the other actors here, because they can buy it from two separate people. There is the United States government. So there is the U.S. Treasury. They are going to issue Treasury bills when they essentially just need to borrow money. And then there's other people that have already bought Treasury bills. So let me draw them over here. So then there are other people. Who own Treasury bills. So this is someone who owns a Treasury bill right over here, wearing a hat, maybe with a little bit of hair and a mustache. So this is someone who owns a Treasury bill. So, and just to give a review, when the U.S. government wants to borrow money, people hand the U.S. government money. So they hand the U.S. government money. I'll draw it as a dollar bill right over there. They hand the U.S. Treasury money, and then the U.S. Treasury gives them an IOU. It gives them an IOU. This IOU is what a Treasury bill is. IOU. And what it entitles the holder of this piece of paper, it allows them to get interest from the Treasury, depending on what type of Treasury bill or bond it will be. It'll be over a certain period of time. I have a whole video on this, especially the ones where I talk about the yield curve. And then at some future date, the U.S. Treasury is going to pay them a larger amount of money than they put back in. So this right here is a Treasury bond or bill. T-bill if it's a shorter duration, Treasury bond if it's a longer duration. So this is a Treasury bond. It is a loan to the U.S. Treasury. Now, the Chinese central bank, they have all these excess dollars. They can buy treasuries from either two sources. When the U.S. Treasury itself needs to raise funds, it will essentially put these IOUs for auction. It will sell them to whoever is willing to take them for the least interest. So let me put it this way. So what they can do is they can give the money directly to the U.S. Treasury when the U.S. Treasury puts Treasury bills or Treasury bonds up for auction. So it can give the money directly to the U.S. Treasury, and then the U.S. Treasury will give them one of these IOUs. U.S. Treasury will give them one of these IOUs, or it could buy it from someone who already has it out in the open market. Or they can go in the open market. This is a very deep, very, very liquid open market. Or they can give these people right over here money, and then they would transfer the IOU over to this central bank. So what is happening at the central bank? What is essentially happening here? What's essentially happening is the Chinese central bank printing money to buy dollars that it will then essentially lend to the U.S. Treasury. So when this whole, looks kind of convoluted, they're doing all this, but the essence of what is happening here is that the Chinese government, you have the Chinese central bank, central bank lending to U.S. government. And it might be buying other assets, but the Treasury bonds and bills are really the main form of liquid asset they might be buying. So what is it? How does this affect the United States? Other than the fact that instead of owing other investors these IOUs, it now owes it to the Chinese. But what is the net effect of having this player out here, having this very significant player out there that is fairly aggressively willing to pay for U.S. government IOUs, U.S. Treasuries? What is the effect of that? Well, we saw in the yield curve video that the more people willing to give you a loan, the lower the interest rates are going to be. And I can show you a very simple example of that. If I'm looking to borrow, and this is no longer, I'm not talking about nations, I'm just talking about Sal now. Let's say that I'm over here, and I'm looking to borrow $10. So I want to borrow $10. And I say, hey, who's willing to give me the best deal on $10? And I'm going to pay you back next week. So you might come along, and say, I'll lend it to you for 10% interest over a week. So you can pay me, I'll do it, and you can pay me $11 next week. So this would essentially be 10% interest over the week. You give me $10 now, and if I agree to you, then I'll give you $11 in a week. That would be 10% interest. But then let's say, I don't know, Mary comes along, and she says, oh, I can do better than Mr. Orange guy over there. This is Mary. I can do better than Mr. Orange guy over there. You can pay me, I'll lend you $10, and you can pay me $10.50. $10.50. next week. So notice what happened. Both of these people have $10 to lend. They're looking to get some return on their $10. If he was the only player here, I'd have to go to him and say, okay, I'm going to pay 10% interest. Then she says, no, 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 I also have $10, and gee, I would be happy with just a 5% return. 50 cents off of my $10 in 1 week, that's a good return. So right now, I'll look at this person. But the more people the more money that's available to borrow, the more competitive this side of the equation is going to be, and the lower the interest rate I can get. You can imagine even a third person who says, no, 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 wait, I've got $10. I've got $10. Let me draw this third person who says, I have $10, and you know what? It's just going to be sitting in my bank account doing nothing unless I lend it to you. You can pay me, I don't know, $10.25 next week. And then I'm going to go to this person. So the larger the number of people willing to lend to me, the lower my interest rate will be. Or another way you could say it, think of it, the larger the supply of money, larger supply of money to be lent, that leads to lower. You could view it different ways. You could view it as lower borrowing cost, which is another way of just saying lower interest. Or you could even view it as cheaper money. It costs less to borrow the money. The cost of borrowing money is the interest. Lower interest. Now, what does that do? What does having lower interest? So this is just a small example with me trying to borrow $10. The more people there are, the more competitive that is, the better interest rate I'll have. So you just take that same notion to kind of a macro level. The U.S. government is constantly borrowing money. The more people out there willing to give it money, willing to buy the U.S. government's IOUs, the lower the interest rate will be. So the net effect of having this major buyer of U.S. treasuries is that having them out there accumulating all of these dollars, taking them all out of the foreign exchange markets, and then using them to buy treasuries, it lowers the interest rate for treasuries. So the net effect is U.S. Treasury has lower borrowing costs, lower interest. So what does that mean? So let's make it very clear. So the Chinese buy treasuries, which are essentially loans to the U.S. government. Then the U.S. has lower borrowing costs. U.S. has lower interest or borrowing cost. And I'm talking about the government right now. Borrowing cost. And now this has several interesting side effects. This means that it's easier for the government to finance deficits, to finance deficits. They don't have to pay as much as in interest to finance deficits. So that means that they can spend more. They can give out more payments to U.S. citizens, or they could lower taxes. Either one, both of those would lead to deficits. So it's easier, so that the government can spend more, or they don't have to raise taxes, or they could lower taxes because they don't have to spend as much in interest. Now, the other interesting thing that the U.S., the Treasury borrowing costs go down, that means that the interest rate on everything goes down. This is the benchmark. This is one of the benchmark interest rates, especially, and you should watch the video on the yield curve if you want to understand more about it. And I know some of you are saying, wait, doesn't the Federal Reserve set interest rates? The Federal Reserve only sets overnight, very short term. If you're going to borrow money overnight in your bank, that's what the Federal Reserve sets. If the U.S. government is borrowing money over 5 or 10 years or 20 years, that is set by the market. That is set by a market mechanism very similar to what I showed just over here. So this is dependent on more capital being there to be borrowed. So 10-year and 15-year and 20-year debt for the U.S. becomes cheaper. But this makes all debt in the U.S. cheaper. This makes all debt in US cheaper. And there's two ways you can think about why this piece happens. One is just on a very superficial level. People say, hey, someone like General Electric is only a little bit more risky than the US government. If the US government only has to pay 3% on its 10-year, on debt that it has to pay back in 10 years, maybe General Electric should only have to pay 0.3% more than that. So that's one. You use the US government as a baseline, and then depending on people's risk, they pay a little higher spread. Another way to think about it is up here. The Chinese government is just pouring dollars either directly to the U.S. government or into the actual U.S. Treasury market. So this guy right now, he has more dollars. He's not going to use the treasuries. He thinks treasuries are too expensive, which means that their interest is too low. So he's going to take these dollars he got from the Chinese and he's going to lend it to someone else. That dollar is still there. He'll lend it to General Electric, or maybe he's a credit card company and he'll lend it to the consumer. So in general, all debt in U.S. gets cheaper. Now, what's the net effect of all of these points? What's the net effect of this? All debt in the U.S. becomes cheaper. There's just more dollars for loan in the U.S., more dollars that people can borrow. The government is spending more, or the government will lower taxes. What is the net effect of all of this? Well, people will either have more money in their pockets because they've gotten a government job, or they've maybe gotten some type of entitlement payment, or they're going to have more money in their pockets because they're paying lower taxes, or they're going to have more money in their pockets because it's easier for them to put more debt on their credit card or to refinance their mortgage. So all of these lead to more cash in American pockets. Now, that's obviously not an unambiguous.
But that it doesn't though. It leads to more debt in Americans' pockets, which still has to get paid back, especially at like the consumer level. Like you can't just continue to borrow in perpetuity like the US government can, just rolling shit over and over and over, right? Like even if you have like a I don't know. Like even for a company, it's difficult to do that.
Obviously
I
good thing because not this is
I
all
don't think
financed with
that's
debt. It's not just
necessarily.
solid debt-free cash. So more cash financed in American pockets, essentially financed with debt. Financed financed with debt. And this debt, as you can see, it's either occurring at the credit card level, it could be occurring even at the corporate debt level, or it's occurring indirectly at the government level. But all of this is being enabled by the fact that China is willing to buy treasuries, which means that China is really just willing to lend to the US. So what's happening? China is lending, China is artificially keeping its currency low, and it's doing that by buying dollars, taking those dollars and essentially lending them to the United States. And that eventually ends up in the hands of American people and companies and even the government. And what are they going to do? Well, they're going to buy cheap Chinese products that are artificially cheap because the currency is lower. So then they will buy buy Chinese and artificially inexpensive. And obviously, they do have lower labor costs and all of that, but it's even lower to the American than it would be if the currency were allowed to freely float. Buy Chinese products. So the net effect of this entire scenario that I've been describing over the last few videos is that the Chinese are essentially lending money to the Americans to then go ahead and buy more Chinese products.
All right, that's interesting, but I think that's a very linear way of looking at it. Like obviously that is not the only fact. Also, I want to see the USD CNY rate. How's this not what I was saying? Oh man. When was this? This was in 93. So this is mostly what a pegged market looks like. He didn't get to the inflation part. Okay, let's keep watching. Let's keep watching. Currently, it's 6.336. No, but like you see his point. Like his point was very kind of is linear the right word? It was like, oh, okay, so this will end up as money in people's pockets, but really it ends up as debt in people's pockets, which okay can cause inflation depending on where that debt gets spent, but also you have to pay back more than you borrowed, especially on shit like credit card money. The debt does equal money, but you have to disaggregate it. Like if you spend that debt on something like a business, which can yield more than you borrowed for, like which can yield more than the interest that you have to pay on it, then you don't run into credit risks. But if you spend it on Chinese goods, uh then you run into deflationary problems when all that shit blows up. All right, let's keep going. Let's keep going.
Now that we have a general layout in our minds of how all of the mechanics are fitting together, what I want to do in this video is discuss a little bit about why the different actors would do what they
Go
are,
listen to
how
Queen
they
Upon.
could benefit or get hurt from this cycle, and really why it's so hard to unwound each of the actors, why it's so hard for them to unwind
Oh yeah,
themselves
one and a
from
half
this
times.
scenario.
Good
And where
call.
I finished off this last video, I talked about more cash being in American pockets because of essentially debt being cheaper, government can spend more money, lower taxes. And I said, that's more money for to buy.
Yo, low key though, somebody added hotspots. I don't know. I don't know if you guys will get this joke. But I've seen these somewhere.
Chinese product, but it's in general more money just for Americans to spend on each other. Just to spend on each other. They might buy each other's houses or buy each other's services. So in a lot of ways, it does stimulate the economy. For any Keynesians out there, the more you spend, that will stimulate the economy. Lower taxes for more conservatives, that also can stimulate the economy. And in general, debt being cheaper, lower interest rates, all of these things stimulate the economy. Now, normally when you're stimulating the economy like this and you have all of these factors, you have the risk of higher inflation. But remember, inflation, or at least price inflation, is just the price of all of your goods. But notice we're buying more and more cheaper goods, and interest rates are low. So to some degree, this whole cycle also keeps it looks, I guess you could say, the surface growth that the average American consumer experiences looks very positive, and inflation stays slow. So we could also say money back, money, money to buy each other's services, each other's services. Now, with that said, let's think about why the different actors want to do this. So let's think about it from the Chinese perspective. Let's think about it from the Chinese perspective. So if you are China and you're starting off, you are a real communist country maybe 30 years ago, and then you start to have market-based reforms and you really want to enter the developing world. But you don't have the industrial base in the late 70s or early 80s to really compete with the Germanys and the Americas and the Japans, and when I say Americas, I mean the United States, on their terms. So one advantage of export-led growth is when you're just beginning to develop. Maybe you have a more, well, you have a less developed society. You have less of an industrial base. So when you have export-led growth, you can actually you actually will encourage investment in factories that can go and produce things for the developed world. So for the developed world. And by keeping your currency low, by artificially keeping your currency low, and let me be clear, a lot of, with just standard free trade, labor costs are going to be cheaper in a place like China or India that has a lower standard of living. So there would be, with just straight up free trade with no manipulation of currency, you would have things that would move offshore, manufacturing and services that move offshore. But if you supercharge it, if you make it even cheaper to manufacture, to do business in China, it'll just accelerate the investment in production in China. So this export-led growth, so let me put it this way. Artificially suppressed currency. And this also happened with Japan after World War II. Artificial suppressed currency. And to some degree, we wanted that because we wanted Japan to become intertwined with the United States. We wanted it to be successful. We saw what happened to Germany after World War I, where it was so economically unsuccessful that it was very easy for a character like Hitler to come to power. So we learned our lesson. We said, it's never good for another country to not have an economic recovery. So we actually, to some degree, many people think, encourage it in Japan. But anyway, you artificially suppress a currency. It makes your exports cheaper. And which then encourages more investment in production at home. So then that leads to more production at home,
But
more
even
production.
that, like, even this isn't like the all-encompassing way of looking at it, because if you think about it, like a country like Zimbabwe, like, why doesn't Zimbabwe, with its extremely suppressed currency, if you want to call it that, have cheaper exports? It's because, how would you think about it if we were to imagine a currency that is shared across the world? Let's just fucking hypothetically make one up, whatever, just world dollar. Whatever productivity you get for one world dollar, uh the higher that number, the more likely you are to export. It doesn't really matter whether your currency is cheaper so much as how much productivity do you get. Zimbabwe has export, yeah.
Production at home, and in this case, when I'm talking about home, I'm talking about China or Japan. And more production at home means more investment at home. More investment. If you're producing more in China, you're going to have to build more factories. More investment at home. And this means literally more jobs and to a large degree capital for the Chinese people. More jobs and capital. More jobs and capital. And as you become more efficient and as you go down that development curve, you'll become more and more competitive over a whole series of industries. And the idea is once
like
you're
the reason they can do it in China and not anywhere else is because their labor is cheap, compared to some hypothetical unit of world currency, right? It's because they literally use slave labor when nobody else is willing to. And so, like, of course their
people
labor
get
is going to be
developed
fucking
enough,
cheap.
once your people get developed enough, you will have enough capital at home. You will have enough of a consumer base at home that some of this extra capacity can then turn back to your own people, that you can then use these goods to sell to your own people to increase their standard of living. So at first, you are building washing machines and refrigerators for the United States and Europe. And because you're building those washing machines, those are jobs for Chinese. And eventually, once they have enough money, once there's a critical mass of a middle class Chinese, that same capacity could be used to sell washing machines and refrigerators to the Chinese, and it would raise their standard of living. So manufacturing. So it builds a manufacturing base. So let me put it builds a manufacturing base and a home market. Let me put it that way. So this is kind of, from China's point of view, it looks unambiguously good. Builds manufacturing base,
It's
manufacturing
trading for trading a currency
base,
that dictates your
and
purchasing power.
and a domestic consumer market. Domestic consumer market, which just means people in China, once they have jobs and they have capital.
But that's not the only thing you need. That's you need all the other shit too. Because if you have a currency that is either extremely expensive or extremely cheap, but you don't have the productive power, or what would you say, the consumption power, like that, then it doesn't mean much.
Will be able to buy the goods themselves. and domestic consumer market. Now, where is the negative here? You can imagine if you are the developed country that is buying these goods, they would be cheap to begin with, but now they're even more artificially cheap. Well, you lose your manufacturing base. So if you look at from the U.S. point of view, you lose the manufacturing base. And it's very clear that this has been happening, whether you want to point to Japan or in general, we've been losing our manufacturing base to other countries. And some people view this as a good thing. Some people say, hey, we are further down the development curve. We shouldn't focus on manufacturing since manufacturing always tends to go to whoever can do it for the cheapest price. We should focus on knowledge things, whether it's pharmaceutical industry or the IT industry. So there's maybe an argument there. But the other reason why this is maybe compelling to the United States is it's lower cost, lower cost, lower cost.
China.
So this looks like a negative, and it
Yeah,
is
I mean,
really a negative on some level. But the one, I guess you could call it a superficial positive, is lower cost for for American for American consumers. So if you're not one of the people who lost their jobs at the manufacturing plant, and you're the great majority of the rest of Americans, it seems like a good thing. Things are cheaper for you. It's cheaper to buy clothes for your kids. It's cheaper to buy cars. It's cheaper to buy a refrigerator. It's cheaper to buy an air conditioner. Now the problem is, when and how does this end? Because this whole cycle that we create, I mean, it might sound good for China. And in theory, it sounds good. You suppress your currency, your goods are cheap, more production at home, more investment at home, more capital and jobs. Eventually, point that investment back at your own home market, and now you are a developed country. Seems to make a lot of sense, but it's easier said than done. In particular, it's not a trivial thing to make that home market be as consumptive or as consumer-driven as maybe some of these developed markets abroad. The other problem is this whole time, remember what's happening. You're just accumulating this mass of, in this case, US dollars, and you're using it to go essentially lend to Americans, to lend to their government, and then it essentially gets lent to the American people. And the minute that you stop doing it, think about what happens. The minute that you stop, let's not even talk about unwinding this. Let's say the minute that you stop buying dollars, your currency will inflate, and the holdings, these trillions of dollars of assets, these trillions of dollars. So the minute that you stop, these trillions of dollars that you've accumulated will drop in value, because the minute you stop buying dollars, the currency markets will allow the yuan to appreciate, the dollar to drop, and so stop buying leads to drop in value, drop in value. And that's just if they stop buying. If they actually ever tried to unwind this situation, you would have, as soon as they start selling these, that would drop the value of, whether you want to call it the dollar or the US Treasuries, even more. And so everything else they're holding would drop in even more value. So the whole time, in order to keep their currency propped up, they've been buying these assets, they've been buying these dollars. But the very act of unwinding it will, I won't say make it worthless, but it will make the value of their holdings go down dramatically. So you have a very hard situation for the Chinese. It's a hard situation to even get out of, and it's just as hard for the U.S. Because if you think about it, a lot of people in the U.S. would look at this and they'd say, "Hey, this is horrible. This is why our manufacturing base has gone away," and it is partially true. And so they say, "Hey, let the currencies just do what they will. No more artificial distortions, no more manipulation by governments. Let the currencies be freely trading." But what would happen then? What would happen to the United States? The minute that China stops doing this, stops artificially supporting their currency, or even worse, the minute they start unwinding all of these dollars that they've accumulated, what's going to happen? They're going to start selling U.S. Treasuries. There's going to be lower demand for U.S. Treasuries because they're not even buying it. They might be selling it. Interest rates are going to go up. Long-term interest would go up in the United States. Now, when long-term interest rates goes up, that means that borrowing is harder, that people will want more interest to lend you money, that credit card rates will go up, and in general, the entire United States economy will go down. Why are we in this recession right now? Because it is harder to borrow, that we were so dependent on cheap debt, and when that debt got a little less cheap, everything kind of ground to a halt. That would be even worse. That would be even worse if the Chinese stopped buying our debt and allowed interest rates to go up. So we are kind of locked in this very perverse cycle, where although it looks like the Chinese are unambiguously, I guess, benefiting from this, they are accumulating these assets, and the minute that they try to stop accumulating those assets, the value of those assets are going to go down. And even though that the United States looks like it's getting their manufacturing base depleted, and that is true, it is getting its manufacturing base depleted because of this, it is keeping interest rates low. And if you're a politician, you like that. It makes the overall environment look superficially positive. I'll leave you there and let you think about this whole situation for a little bit. In the next video, I'll try to do a little bit of analogy to think about where all of this might go.
mm, I don't know. There are a couple of there are a couple of assumptions that he's making there that I don't so much agree with. Maybe I'll bring it up on the next stream. I don't think that uh, lower rates, or excuse me, higher rates would lead to, especially on the long term stuff. I don't think that would lead to deflation. I think that that's quite the opposite, and we can observe that in the real world. Like Turkey just literally went through the shit where their inflation spiraled out of control and their rates shut the fuck up because, number one, because of the risk that you take by actually lending in that market. So like you'd want to get paid on the rates. You'd want to get paid. mm, I don't know. uh but there's some truth to it. I think that he just looks at it in a very kind of linear way, and doesn't take into account a whole bunch of other shit. We're gonna look more into this. This is a good resource. I didn't know Khan Academy had this kind of shit. Well done. Interest rates that bank charges, not what they pay out. Your Hanus is locked on these nuts. All right, let's do a quick little recap of the markets, and then I will let you guys go. I'll bring up some more inflation, deflation stuff. I think the video to watch in response to this will be Richard Werner's Princes of the Yen, because I think that covers from an empirical perspective the effect that low rates versus high rates and the QE stuff has. And we'll bring that up on the next stream. All right, let's cover the markets, see where we are after the first hour of trading. Ethereum still within the first expected move. Looks like a down day. 70% chance we close today above 2,993. Maybe the music is too loud. Check. All right. Like if they pay out a lot, then that causes inflation. If it costs them too much, then everyone will have less. So I think the order of events there is backwards. I think inflation happens and then rates move, or I think deflation happens and then rates move. We'll go over this. All right, for Bitcoin, also within the first expected move, 70% chance we close below 45,367 and above 4,272. I remain long on volatility for Bitcoin, especially as HVP is at 9, very low, seems to be rising over time. Next 30, 60, 120 days, I think we will see some craziness. Currently, the big changes in price are expected to the upside as long as you are above the due. And keep an eye on the QCV. Looks like it's crossing up. Let's see how the trads are doing. S&P 500, not much. The scary part here is being below the due on the daily, being below the due on the weekly, and the daily entropy moving down, suggesting a more favorable environment for Delta traders. Still have room for volatility, likely a spike in this week and next week. I don't really want to call the exact time on that, but be aware of this. It's on the lower band here. It has been grinding here for quite a while. When double ear stereo mic? Good question. All right. How is Nasdaq? Down day for Nasdaq. Entropy moving down. Scary stuff here. HVP at 80, so still have some room, although not much for a volatility expansion. Looks like the daily SSR is moving below the middle band, so keep an eye on that. Currently, the big changes in price are still expected to the downside. The entropy and MOM and the DO are kind of what's making it scary here. Also, we might see Hearst enter into trend. It hasn't been trending for a long time, since when was this? Since December of 2020. Holy shit. Crazy stuff. So do keep an eye on that. That will be pretty damn significant. We don't get too many occurrences like that at all. With that, I will leave you guys for today. I hope you guys have an awesome day. I won't be on tomorrow. I will be at the driving lessons, but I'll have some videos prepped for Thursday, and we'll do some setups and hopefully move some more of my shit over to Delta. I hope you guys have an awesome Tuesday and an awesome Wednesday. Enjoy the day, guys.